Hello, my name is Joe Hoyle, speaking to you today from the University of Richmond. And we're ready to look at the stockholders' equity section of the balance sheet. In this book, we have spent a lot of time looking at assets, liabilities, revenues, and expenses. But there's a lot of interesting information that you can find in the stockholders' equity section of the balance sheet. So in this chapter, we look at that section very carefully to make sure that you understand the terminology and the accounting that you are seeing. You need to start by realizing that in this country, there are three major ways that you can create a business. You can create it as a sole proprietorship, one owner. You can create it as a partnership, two or more owners, or you can create it as a corporation. A corporation is legally separate from the ownership, and that is done by the state government. Virtually all businesses of any size are corporations. There are simply some advantages to being corporations that make them so very prevalent in the business world. Now, you will find occasionally a partnership that's fairly large in size, but a big organization is almost inevitably a corporation. So here in this textbook, we spend our time looking at the corporate form of organization. One of the major advantages of having a corporation is that you can sell capital stock. Therefore, you can grow quite large in a corporation because you can take your ownership shares, the capital stock, and you can sell it to the public or to your friends or to whoever might want to buy. One of the reasons that people are willing to buy the shares of a corporation is that a corporation, because it is a separate legal entity, provides limited liability for its ownership. In simple terms, that means that the owner can lose what is invested in the business, but cannot lose more than that. So when you go into a corporation, you know the upper limit of your risk. In a sole proprietorship and in a partnership, there is no upper limit because there is no separation. But if you invest $35,000 in a corporation, yes, you can lose $35,000, but you cannot lose more than that. So you know the limit to your risk. So here in this chapter, we talk about capital stock. We mention common stock, we mention preferred stock, and then we also talk about treasury stock. Before I mention those, I do want to tell you though, if you're selling, issuing stock, or buying it back, you cannot create an income statement effect from that type of transaction. You cannot change your net income in dealing in your own capital stock. The reason is that this is ownership being invested into the business or taken out of the business. This is not an exchange. It is people putting money into the corporation or people taking money out of the corporation. That's not viewed as an income statement effect. All corporations have common stock. The ownership of common stock gives you certain rights. Those rights are set by the laws of the state of incorporation. So if your business incorporates in Delaware or Nevada or someplace else, the rights of the common stockholders are set by the state laws. Typically, an owner of common stock can vote for the board of directors. That's one right that's pretty much universal. And if a dividend is paid, that stockholder has the right to his or her proportionate share of that dividend. If you're an owner and have not given up that right, you cannot be left out. So if you look at any business, yes, they have common stock. Some businesses, probably 10-15%, also have preferred stock. Preferred stock has its right set by the contract. It is not set by state law, it's set by contract. So therefore, the rights of preferred stockholders can vary significantly from one company to the next based upon the contract. Most preferred stocks have some specific rights as to dividends. Frequently, a very set dividend has to be paid to the preferred stockholders before any dividend can be paid to common. That would be a common type of preference that you might see. For example, you might tell the preferred stockholders, we will pay you $2 per share, and we will not pay common anything until that $2 is paid. But after the $2 is paid, we will pay common whatever we can. So you can have common stock, you can have preferred stock. You can also have treasury stock. Treasury stock is your own stock that you buy back. So you might issue 1 million shares of common stock and for one reason or another buy back 100,000. The shares that you buy back are referred to as treasury shares. Why do you buy treasury shares back? Why do you in effect give your money away to get your own stock back? Well, this chapter talks about a number of reasons why a company might buy treasury stock. But one of the most common is that some companies feel that if they buy the stock back, it will help to boost the stock price. So if your company's stock has not been going up enough, one strategy that companies use is to buy back treasury stock to hope to increase the demand for stock and to decrease the supply as a way to increase the stock market price of that stock. Now, when we issue common stock, preferred stock, or buy back treasury stock, there's some terminology that you should know. Authorized shares is the total amount that you're allowed to sell. The state sets that based upon what you ask for. Issued is the number of shares that you've actually sold to the public. Outstanding is the number of shares that's being held outside the company at the current time. The difference in the issued shares, the number you've sold, and outstanding, the number in the hands of the public at the current time, is the number of treasury shares. Whenever you issue common stock or preferred stock, you typically record the asset that you get, that makes sense, and you record the stock at its par value. Most shares of stock have a par value printed on them. As the chapter indicates, the par value at one time had a meaning. But nowadays, the par value typically has no relevance. It's a throwback to an earlier time. For that reason, most companies set their par value at extremely low numbers, often a penny. So you record the amount you receive, you record the stock account, common stock, preferred stock, at par value, and the amount that you get over that par value is typically put into an account called something like capital in excess of par. The contributed capital is those two accounts, the common stock or preferred stock account at par value plus the capital in excess of par. If you buy stock back as treasury shares, those are recorded at cost. The treasury stock shows up also in stockholders' equity, but as a negative. Contributed capital is a positive because it measures the amount of money that came into the company. Treasury stock is a negative, and it measures the amount of money that went out of the company to buy those shares back. Now, if you have stock, you will often pay dividends. The most common type of dividend is, of course, a cash dividend. The cash dividend is decided by the board of directors. They are the only ones that have the authority to give away the company's money, so they must make the decision about dividends. On the date of declaration, the day they make the decision, the company reduces its retained earnings and creates a liability. On the date of record, it indicates who is going to get the dividend. There is no journal entry made on that date because all that's trying to do is to determine who is entitled to receive that dividend. So the date of declaration, the decision is made and a journal entry is recorded. The date of record is when you have to own the stock to get the dividend. And then the date of distribution is the day when the checks are mailed. And on that day, you reduce cash and reduce the liability. A company can also have a stock dividend. It doesn't give away cash or some other asset. It gives away more stock of its own company. So for example, a 10% stock dividend, if you owned 100 shares, you would receive 10 more. If you had 1,000 shares and a company had a 20% stock dividend, you would get 200 more shares. A stock dividend is often issued as a way to bring the price of a stock down so that more people might be interested in buying it. How do you record a stock dividend? Well, once again, you reduce retained earnings. That's just exactly like in a cash dividend. The question is, though, how much do you reduce retained earnings by? If it's a small stock dividend, you don't give away too many shares, you reduce retained earnings by the amount of the fair value of those shares. If it's a large stock dividend, you give away a lot more shares. Then again you reduce retained earnings, but this time by the par value of the shares. So retained earnings goes down in any stock dividend, and instead of cash going down, your contributed capital goes up. This chapter ends with a discussion of a very important topic, earnings per share. This is a number that has to be reported on the income statement for every publicly traded company. And the reason is it's a highly discussed number when you're trying to evaluate a company. Almost everyone who invests at least somewhat looks at earnings per share. Because of its importance, I want to make sure you understand what it represents. Earnings per share is a common stock computation. You take the income that is allocated or assigned to common stock and divide it by the outstanding shares of common stock. It's a simple computation. Take the income assigned to common stock and divide it by the number of outstanding shares of common stock. Now this gives you what we refer to as basic earnings per share. Now let's touch on both of those for a second. The income that you assign to common stock is the total net income less any preferred stock dividends. Since preferred stock gets its call to dividends first, then common stock is only entitled to the income after the preferred stock dividend. So in making earnings per share, we reflect that by taking total net income and subtracting the preferred stock dividends. What you have left is the net income that we can assign to common stock. That's divided by the number of shares outstanding. Now, what happens if the number of shares over the course of the year changes? You use a weighted average for that period. So basic earnings per share is net income that you can assign to common stock divided by the weighted average number of outstanding shares of common stock for the period. One other number that we sometimes compute is diluted earnings per share. Diluted earnings per share takes the basic earnings per share and changes it by including any convertibles. A convertible is something that you can turn into common stock. Since it can become common stock, it could impact the earnings per share. You want to show investors what that impact would be. So what we do is we assume conversion. We take each of those convertible items and we assume it was converted. And then we factor in how that would change earnings per share. So basic earnings per share is simply the income for common stock divided by the number of shares outstanding of common stock. Diluted earnings per share also includes any convertible items by assuming conversion. In addition, in this chapter, we do mention the price to earnings ratio, which is more commonly called the PE ratio. It's simply the price of the stock divided by earnings per share. Again, this is a number that's widely discussed in the business world. because many people feel that it will help them to be able to anticipate what the price of the stock is going to be if they have an idea about how earnings per share is going to change. Here in this chapter, we've looked carefully at stockholders' equity, common stock, preferred stock, treasury stock, earnings per share, cash dividends, stock dividends. A lot of topics that everyone in the business world has to know about to be able to properly evaluate an organization. Go read the chapter. I hope you learn a lot that you can use.